you might lose everything and quit trading altogether, which is actually the more likely outcome and a distinct possibility if you understand how quickly and easily options lose their value much faster.
Now, talking about how quickly options lose their money, right? This is what's called gamma risk. Okay. Gamma risk occurs in the last week, and this happens to both of them. This is why I won't hold an option into the last week. As the gamma risk, as the risk of, let me rephrase that. As we get closer and closer to expiration, there is a higher likelihood of these getting in or out of the money happening faster. What do I mean by that? Let's change this to all expirations. And what you're going to see here is the 14 delta has a 14 strike has a 77 delta with 16 days to go. Clayton says, I like your new teachings. Perfect. Thanks for subscribing, dude. 14 delta, 14 strike, 77 delta. 14 strike, and 88 delta. Now, why is that? That's because your gamma is expanding. The change between these is expanding. So to go from the 16, because we're now out of the money on the 16, the 15 is in the money, but it's still at the money. To go from the 16 to the 15 and a half here, that's a huge jump. In fact, how much is that? The delta changes by, let's say 30 right here between at 16 and 15 and a half. Let's go out 1 week. This is not 30. This is, what is this? 13. Let's go out another week. This is 9, right? So as we get closer to expiration, the delta change between each of them, that's called gamma. The delta change between each of them expands bigly, real bigly, hugely. It's so big. It is tremendous. It is just amazing how big the delta can change every time you get closer and closer to expiration. That's your gamma. Your gamma gets out of control. Your gamma gets out of control. That's why we call it gamma risk. It's because you can have a stock that a couple weeks ago, you had a 79 delta. I don't know why I just changed it to 95. Oh, I went to the current one. A couple weeks ago, a couple weeks until expiration at 79 delta. It expires tomorrow and you're down to 95 delta. Huge, big change, bigly change. Okay. That's what gamma risk is right here. And that is how fast it can fall off a cliff. How fast it can fall off a cliff. So you don't want to be trading the last week on options because it can literally go to zero. Also, let's talk about the word consistency, right? Consistency is a very loaded term, right? Because I am a consistent trader following my plan. I don't get to tell the market when I get paid. If you need to get paid before the end of the month so you can pay your mortgage, pay your bills, pay everything through the stock market, it's just going to laugh at you. It's just going to be like, you have no idea how this is done. You wanted to be a pro trader, but I can tell you one thing, you don't get to decide when you get paid. So by having that expectation of getting paid on a regular basis like you would in a day job, it's not going to work like that. I have an idea. Hang on. Let's talk about, okay. Let's say that you're doing a $1 wide spread, okay? A $1 wide option spread, which is where I think he's going here. And let's say that you sold it for, let's say you sold it for 20 cents, okay? Which means you have 80 cents of risk. How do I know that? The difference in the spread, so this is a $1 wide option spread. What does that look like? A $1 wide option spread is essentially, let's say you're going to sell a $1 wide put spread, okay? Let's say you went to this Friday. Let's say you went to, what delta is this? The 9 delta. That's super, God, this is worth absolutely nothing. The 22 delta. And you went a $1 wide spread here. First off, you're going to make all of basically nothing. You're going to make all of 10 cents. You might make 10 cents on this. Okay, great. Let's review this. The risk you have in this trade is the spread width. Okay, so 15 minus 14 is $1. So the risk in this trade is actually 90 cents. So that means if and when you lose on this trade, you now need 9 perfect trades in a row to make up for the 1 loss. All right, you're not making any money here. Not at all. You need 9 perfect trades in a row. What's our expectancy here, right? Let's say you had an 84% win rate in this strategy. What's our expectancy? What is our expectancy? This is how you calculate expectancy. Expectancy. In fact, these are dollars. All right, expectancy. You take your win rate times your average win, okay? You subtract your loss rate, so 1 minus this, so 16%, times your average loss. Ready? Your expectancy is expect to lose 6 cents on every trade. But I had an 84% win rate. Doesn't matter. Expect to lose 6 cents on every trade. You go watch the Alpha University or Outlier University Alpha class and Outlier University Bravo class. Go watch those.
If the index closes cleanly above the 20-day moving average, we're going to start the trade. And if at any point during the trade it closes below the 20-day moving average line, we...
Now, here's one thing that a lot of people struggle with because they want to find leading indicators. You're there for the juicy goodness of brisket in the middle, right? That's what you're there for. You're not there for the bun on the top and the bun on the bottom. Think of it this way. As price is moving, it's creating those buns. And then once it crosses over whatever moving average you want to use, that's where the meat starts, okay? And then you get in and you can hold it all the way up. And then once it starts to peak, it creates the second bun on top. And we don't know where it's going to peak. I mean, there are some fake gurus out there on YouTube who will tell you all day, every day, they caught the exact bottom. They know exactly where it is. It's only going to go up from here. It's only going to go down from here. They're full of shit, right? Pardon my language. But for the rest of the world who's actually not full of baloney, we're looking at a situation where we don't know where the top is. And so we let the top come back down. And then when it finally crosses back under, that's where you get out. That's your exit signal. Now, you're not going to get the top 10%, and that's fine. You're not going to get the bottom 10%, and that's fine. But you can make so much money getting the meat in the middle, the 80% in the middle, okay? Now, again, do you have to do it this way? No. Is this a lagging indicator? If you want to call it that, by all means. But you can make a buttload of money. You can make a buttload of money on the 80% in the middle. Let's talk about what short puts and long puts look like. So short put option. Okay, short put option, image. When you sell a put or sell an option, that means you're going short the option, okay? This is what a short put looks like. It is a bullish trade. It is a bullish trade. Now, the strike price that you sell it at, so in this case, the 548 here, anything above that, you're going to get your max profit. Anything below that is where you start to lose money. Now, of course, you can sell it when the stock price is way over here, so it has to move a huge way down, a tremendous way down to get to your strike price. But the further away you sell, the smaller. Let me draw on this. Are y'all enjoying this? Do me a favor. Type #outlier in the chat if you're enjoying this. I would really appreciate knowing, right? Let's say you sell it here where the price is at, let's say $50. But the strike price that you sold is 45. So it has to come down $5 to get to your strike price. And only once it goes under 45 do you start to lose any money. Okay, y'all are enjoying this. Okay, good. I don't think you understand how hard I can nerd out on this. I love this so much. The concept with the options is the technical fun part of the game that I love. Now, when you do a short put spread, you are not just selling that option, but you're buying another option below that. Okay. So in this example, you have theoretically unlimited risk here, theoretically unlimited. But if you make this a put spread, you do cap your risk here. Okay. So if this was the 45, this would be the 44. So you've got a maximum amount of risk of just the difference in the 45 and 44. Now, you're not going to sell it for $50. You might sell it, in our SoFi example, you might sell it for 8 or 10. So you're taking 10 whole dollars, yet you're risking 90. You're risking 90 in this case. Now, that right there should be a big red flag. You're telling me I have to risk $90 to make to make 10? I have to risk $90 to make 10. Yeah. If you want to be successful with this strategy, that's how it's done. But I feel like it breaks something. It breaks some brains. Michael Ross, the boss. Good to see. Dude, you look sharp in that hat. Nice looking, boss. All right. Nerd City. All right. Very, very cool. I feel like this breaks something. I can't remember. Do you guys remember off the top of your head what it breaks? Like the platinum rule, the stainless steel rule. I'm thinking of all the different Rolexes. The titanium rule, the bronze rule, the white gold. Oh, gold. Hang on, wait. Does this break the golden rule of leverage? The golden rule of leverage? It absolutely does. What is the golden rule of leverage? The golden rule of leverage is never put yourself in a situation where you can lose more than you can win. That's exactly what this is. This breaks the golden rule of leverage. You absolutely can lose 9 times more than you can win in this case. The reality is that selling options is a losing game. The only way that it works is if you have a big enough portfolio where you can put on hundreds of different trades like this, right? Think of it like a casino. When you walk into a casino, you understand that you have a negative edge. You know you're going to lose on the outset, okay? But you might get lucky every once in a while. You might put in your quarter and you went and you made $10,000 on the one. That's awesome. The casino lost $10,000 on your 25 cents, right? If you sell options, that could be you. You take your 25 cents you sell and you lose 10,000 on the trade, okay? Things like that really do happen, and it absolutely happened to me. So if you are looking for small account strategies, this is what I would do instead. I would go into Ovtlyr. I would set my screener. You're right. Small accounts can't throw 10,000 at that. So I got an option for you. You reset your filter and you say, give me stocks that are under $16. Hit apply. Now you can start trading stocks that are low in cost. And I don't know if they're going to have enough option liquidity, right? But let's just say we find one that's around $6. Oh, SoFi has around $16. How about that? How convenient. SoFi is right around $16. Okay. And you can buy the deep in the money long call. I would go for a little bit of time, maybe 30 days, right? Let's say you go with the 80 delta and it's going to cost you a little bit more. But here's the thing. This is a valuable asset versus selling the option over here. Right. Let's take this off. The most you can make on that option sell is 38 cents. The most that you could make on this move, if it actually pans out, is unlimited. Yes, you're going to pay more, but you're paying more because it's worth more. It has more moneyness. And because of that, that's where I'd go. I would skip these tiny trades because more than likely you're not going to put on one of them. You're probably going to put on 4. And if you put on 4, where are you at? You're basically at the same point over here, but you have handicapped all of your profits by doing so. What the Schnell film says, it's unbelievable until you sell one that goes south. Then you start praying to the golden leverage god. Yeah, exactly. You just called SoFi a valuable asset. The deep in the money long calls, those are valuable assets. The SoFi stock, is what it is. But it has to go up, bro. Trust me, bro. Trust me, bro. So listen, I hope that this was useful. I really do. If it was, do me a favor. The YouTube algorithms are really rewarding us when we have people like and hype the video. If you've watched to this point, like and hype it for me. It really, really does make a difference. And if you're ready to save time, make money, and start winning less risk, click one of these 2 videos and have